Hello, everyone. Thank you for being here. So today we had the pleasure to have Bill Nygren to be here. Let me just give him a quick introduction. So Bill Nygren is the partner and CIO of Harris in the U.S. So Bill has been a manager of the Oakmark Select Fund since 1996 and Oakmark Fund since 2000. He was a manager of the Oakmark Global Select Fund from 2006 to 2023. Mr. Nygren is also the Chief Investment Officer for U.S. at Harris Associates when he joined back in 1983 and the Vice President of the Oakmark Funds. He served as the firm's Director of U.S. Research from 1990 to 1998. Mr. Nygren received many accolades from his investment career, including being named Morningstar Domestic Stock Manager for the year of 2001. He holds a MS degree in finance from University of Wisconsin's Applied Security Analysis program, and also a BS in accounting from University of Minnesota. With that, let's all welcome Mr. Nygren. So in today's session, the way we're going to break it out is in the first 45 minutes, we're going to do ask him some prepared questions, and then we will leave some time in the end for students to ask any questions as you wish. So Bill, again, welcome to be here. So let me start with some background or investment approach questions. Could you please share with us the story how you started your career at Harris and what has kept you there for more than 40 years?
Sure. So as you heard, I was at the University of Minnesota got a degree in accounting. I knew at the time that the investment business was where I wanted to spend my career. And to me, the idea that if I wanted to work in Spain, I should learn Spanish. If I want to work in finance and investments, accounting's kind of the language of finance. I thought that was an important background. I then went to the University of Wisconsin, largely because I could get in there right away without a career break, without needing to go into the workforce for 3 or 4 years. And I could also get my degree in 12 months because I had an undergraduate in business as well. They had a program, the Applied Securities Analysis course, which was one of the few courses at the time where students were in charge of a portfolio of real money. And there were a group of 14 of us. We broke into 2 teams and managed investment portfolios. After there, I went to Northwestern Mutual Life for 2 years as a generalist analyst. And I think the important lessons I learned quickly there were I wanted to work at a company where investment success or failure drove the success or failure of the business. Northwestern Mutual, great insurance company, but their success or failure is largely determined by their ability to sell life insurance. And secondly, learned the importance of having an investment philosophy that was similar to that of the people that you worked for. Northwestern Mutual wasn't known as a value shop or growth shop, but I was very definitely on the value side. So I would be recommending something, the chart looks like this, the stock's gone from 40 down to 20, now it looks cheap. I'd recommend it, and the managers there were uncomfortable buying something until it had a better fundamental pattern. So I mean, it's not about who was right or wrong. It was, we were 2 ships passing in the night. They weren't getting much benefit out of my research, and my research wasn't at all wasn't giving me any satisfaction because it wasn't resulting in stocks getting purchased. So one day I called up the guy who was the advisor to the applied program, the professor, and told him that this position wasn't working out very well, and if he heard of anything in the industry that he thought might be more suitable for me, that I would appreciate a call. One day I'm sitting at my cubicle, the phone rings, and the entire conversation is, Bill, this is Steve Hawk. You're going to get a call in a minute from an alumni you don't know, Clyde McGregor, who works at a firm you've never heard of, Harris Associates. You should take the job. I have to hang up now because he's calling you. Click. And within 10 seconds or so of hanging up the phone, Clyde called. I went down, I met the people from Harris Associates, and where before there was just no match at all in the ideas that I thought were attractive relative to those that the portfolio managers did, we went through a whole dinner of sharing ideas. You know, they'd ask what I was working on. It was something they'd been working on, and they'd tell me what other names they were working on. It was something that interested me. And I knew right away that there was kind of a meeting of the minds of a value investment philosophy. And managing money was Harris's only business. So you know, definitely success or failure of the investment performance drove success or failure of the firm. I joined there thinking this is going to be a great spot for me for the next 3 to 5 years. The people are smart. I'm going to learn a lot. And 40 years later, still there.
Thank you for sharing. That's such an interesting experience. So you mentioned you're definitely on the value side. Could you share with us, like, what are your core principles and the approach to value investing, and how is your research process to like identify like undervalued companies with growth potentials?
So there are 3 things that we look for at Oakmark in companies that we want to invest in. Number 1 is a significant discount to business value. We target buying at ballpark 60% of business value, selling ballpark 90%. It can vary a little bit based on the liquidity of the investment or the risk profile of the investment. Obviously, the bigger the risk, the larger discount we want. I'll get into how we define business value in a minute. Secondly, we want the combination of expected per share business value growth and dividend yield to match what we expect from the market. So the S&P today, you might say, has maybe 6 or 7% expected earnings growth, 2% dividend yield. So something like an 8 or 9% total return. We don't care whether it's got a dividend of 9% and no growth, or 9% growth and no dividend. But that combination we want to at least match the market. Because if it's not, then time kind of becomes your enemy. The longer it takes for value recognition, the less your return is going to be. And if the business value and dividend is at least matching the market, then you get the luxury of a long time horizon, where if you think the business is worth 100 today, it's 109 a year from now, 118. And if it takes 5 years for that gap to close, that's just fine. The third thing we look for is managements that are aligned with the outside shareholders. Obviously, in corporate America, there can be an agency problem where you own stock, but you don't get to run the business. So it's different than a single proprietorship. You've got a board of directors that you get to elect as shareholders, and the board of directors chooses the CEO of the company. It's really important to us that that board of directors looks at their job as hiring a CEO that they think is most capable of maximizing long-term business value. When we've got all 3 of those, you've got the large discount to start with, the growth that's at least matching the market, and a management that is aligned with outside shareholders. Then you get the luxury of the long-term time horizon, and the longer it takes for the market to recognize business value, the greater our eventual return will be. And we think it's really, the management part of this is really important, and it's something a lot of value managers don't spend a lot of time on. Because if you think you're going to own a stock for 5 years, it's very likely during that time horizon that something will come up to management. They'll have an opportunity to make a game-changing acquisition. Maybe someone will come to them offering to buy a division of the company. They generate a lot of free cash flow generally because they're cheap stocks. That's why we own them. And how they choose to invest that is really important. Are they just trying to grow the scale of the business, or are they focused on per share business value? And we want to make sure management management is aligned with outside shareholders, and one of the most important indicators of that to us is when we look at what their personal economics are. Are their incentive plans aligned with things we believe grow business value? Essentially, do the metrics have denominators? You know, we don't care about just sales or just income. It's sales per share, income per share, return on invested capital, those types of metrics. And we like to see managements own a lot of stock and have options on stock as well. So those are the three metrics. I think how we define value is somewhat interesting because, again, it's not quite the same as a lot of our value peers. Most value managers, when I started in the business, everything was, it's either cheap on PE or price to book. And those are two GAAP accounting metrics that were very important to defining business value. And I think we have evolved more from that than the typical value manager has, to where we would say, like, GAAP accounting was great for an industrial society, where if you're making an investment to grow, you're buying a new building a new plant, you put it on the balance sheet, you depreciate it for 20 years, and matching is pretty effective between costs and the revenues that it'll generate. In an information-based economy, things today are so much more, growth investments are so much more R&D spending, customer acquisition cost, building a global platform, of course, normal marketing and advertising expenses. All of those go straight through the income statement. And we make adjustments at Oakmark for anything we think is a growth investment that goes through the income statement, effectively trying to capitalize it and better match the expenses with the period it'll benefit the companies. So if you look at our holdings, it ends up meaning that there are times we can own something like a Netflix or the cable TV companies earlier in my career, when they had negative book value, they were reporting losses, and people would look at those sometimes and say, well, how can you claim you're a value investor? The PE is really high here. But like with the Netflix, we would say the market was valuing it at about $300 a subscriber, which was cheaper than some of the cable networks that, again, were in slow decline while Netflix was rapidly growing. Or how can you own an Amazon at a high PE multiple? On a price to sales basis, when we've owned Amazon, it's been cheaper, or enterprise value to sales, it's been cheaper than the bricks and mortar stores it was putting out of business. So we think it's really important to not only adjust for income statement investments, but also to understand what non-traditional metrics are good indicators of value in the businesses that we're purchasing. And when we say business value, to us, a company is worth the maximum price an all-cash buyer would pay to own the entire business and still earn an adequate return on their investment. And the whole research process for us is trying to estimate what that business value is, understand how rapidly the business can grow, get to know the people that are making the decisions for running the company, making sure they're on the same page as the outside shareholder, and then waiting patiently for a time when maybe a bad quarter result or something else the investment community doesn't fully understand creates an opportunity to buy a company like that at a big discount to value.
Thank you for sharing. Bill, so you mentioned in some other podcasts that your analysts and you spend a lot of time looking for high quality business that the market isn't giving them the credit for. So could you walk us through maybe an example, like, how did you identify that, and what are the attributes of that kind of opportunity that you were looking for?
So I think one of the areas where investors tend to make kind of repetitive mistakes is being overly focused on organic sales opportunities. When investors think about growth, that's usually the focus, is what kind of organic sales growth opportunities does the company have. And companies that have high organic sales growth tend to get pretty high multiples, and we would look at them and say, these are high quality businesses, but at the prices they're selling at, we can't make the argument that they're selling at less than 2/3 of value. Where investors don't pay as much is the growth that comes after the sales line. So companies that have opportunities to improve margins, maybe they have great economies of scale, so as businesses, even with slow growth, top line's growing 3 or 4%, maybe expenses only need to grow at 2%, so you get margin improvement and operating income that's growing faster than sales. And an area that certainly doesn't get a lot of credit is how is the excess cash flow the company's generating going to get invested? And we spend a lot of time forecasting out for the next 5 to 7 years what a company's capital needs are going to be, how much of the cash is excess, and what possibilities are there for reinvesting that. And lots of times it's as simple as they don't have great opportunities, and they can grow value by shrinking the share base. So you can find decent, relatively low-risk businesses growing top line at 3% a year, where EPS are expected to grow double digits because the share base is shrinking so fast. I'm not going to try and argue GM's a really super high quality, great business, but their stock is so cheap right now, $40 a share. They earn something like $7. They're repurchasing 20% of their outstanding shares this year, largely with the cash that will get generated over about an 18-month time period. So if you shrink the base by 20% and the business doesn't grow, EPS grows 25% over that 18-month period. If that was coming from organic growth, the stock would be selling at 40 times earnings today. So we're looking for those kinds of opportunities that the market might miss. We're looking for opportunities where there might be two divisions inside a company, one performing really well, one losing money. A stock that we own today, Centene, they're in the Medicare Advantage and Medicaid kind of managed care business, I guess you would call it. If you just looked at the stock today, you'd see it's trading around 75. It's earning about $7 a share. You'd say it's selling at 11 times earnings. It's not all that different than other insurance companies. But inside of there is a really good Medicaid Advantage business, or Medicaid business, and a Medicare Advantage business that's losing money. There's a market for Medicare Advantage businesses, even if they're not making money. And if you add back the losses from that and add a value for what the market tends to pay for the poorer run Medicare Advantage businesses, then instead of 11 times earnings, it looks like it's selling at 8 times earnings. And we think in managed Medicaid, they are an exceptionally good company. So here's a chance to buy at 70% of the multiple that other insurers are selling at, one of what we would consider the highest quality healthcare insurers out there. And it's obscured by the by the division that's losing money. So those are the kinds of things that we're always on the hunt for.
Great, thank you for sharing that example. That actually leads to my next question. So by looking at Oakmark's letter you sent out, we saw that you actually sold a couple of growth stocks, including Netflix, and buying a lot of cheap value stocks. So as a portfolio manager, how do you make the selling decision? Could you share some thoughts on that?
Yeah, we're doing a webcast in a couple weeks, and the title of it's going to be "Why We're Selling All the Stocks You Love." If you look back, maybe 15 months ago, after or in the midst of the 2022 market, where growth underperformed value by 2,500 basis points, that created an opportunity for us to buy lots of higher quality, more rapid growth businesses without having to pay up much for them. So we were purchasing companies like Uber at a double-digit free cash flow yield, Adobe, the great graphics business, fantastic growth record. We were able to pay a PE for that they were going to grow their way into a discount PE in just 2 years. Netflix at a discount on a per subscriber basis to what cable TV networks were selling at. But what's happened over the past 15 months, last year growth outperformed by 3,100 basis points. It's another 700 or so far this year. And those stocks that were kind of unusual holdings for value managers performed really, really well. And we were able to sell them at what we thought was very close to full business value. At the same time, the lower PE multiple stocks didn't do much of anything last year. So the PE multiple spread kept growing. I think if you look at, like in the S&P 500 today, the 100th highest PE stock is somewhere in the low 40s times earnings. The 400th highest is just over 10 times. So like a 4x multiple between the 80th decile and 80th percentile and 20th percentile. That's significantly larger than that ratio has averaged for most of the past 50 years. So to us, it's indicating that the value is again residing in the really low PE companies. And it's just kind of a really simple example. A year and a half ago, we owned CVS, and it was selling about $100 a share, making something like $8 a share. At 12 times earnings, we thought it was pretty fully valued, a little bit below average company, didn't deserve an average multiple. So we were able to sell 3 shares of CVS to buy 1 share of Adobe. Adobe selling at 300, supposed to make like $15 a share a year out. We thought it deserved a multiple more like 35, 40 times earnings, not the 20, 22 it was selling at. Fast forward a little less than a year, the CVS that we sold had fallen from 100 to 70, and the Adobe had gone from like 290 up to 450. So we originally sell 3 CVS to buy 1 Adobe, and then we were able to flip that trade, go the other direction, and sell our Adobe share and get back 6 shares of CVS. So effectively doubling our percentage ownership in CVS by having spent most of that prior year owning Adobe. And to me, that's just what value investing is. You're constantly trying to cycle the portfolio and get out of the names that are selling at the closest to intrinsic value and recycle that capital into the names that are at the largest discounts.
Makes sense.
I think something kind of interesting in the way growth has done so well in the past decade is lots of managers, we all like to look back and see what our mistakes were, and then you try not to make those same mistakes again, and you think you're getting smarter doing it that way. I think a lot of managers have looked back and said, when things hit my sell target, I sold, and I look back and I shouldn't have because those names kept going up. And it's made a much smaller percent of the capital in the market today very price sensitive, which I think is part of the reason we're getting the kind of opportunities we are to see such extreme performance, because you don't have as much natural selling into strength as it used to be when most investors had more price sensitivity.
Got it. Next question I have is more about the value trap. So now that ESG is a really popular theme, so for a lot of companies in the chemical industry or let's say coal, I think the multiples are pretty low right now, but we're curious about your view on like such companies in those industries. Because of the ESG initiatives, do you think they're likely going to be a value trap or?
Well, ESG kind of turned from a really interesting way of looking at fundamentals in your portfolio to kind of a marketing catchphrase that became overly politicized. We, at Oakmark, we have always looked at ESG factors. I mean, I talked earlier about the importance of governance and having a board that understands their role of being the shareholder's representative. The sustainable has always been something we've looked at. We want to make sure we aren't capitalizing an earnings stream that's either significantly higher or lower than is typical for the company. And you look at things like, are there employees leaving? Is it possible that they're underpaying? Is there something, is the company taking advantage of employees or customers or some of the other stakeholders in a way that is going to affect their earnings going forward? And on the environmental, you want to make sure you're fully accounting for cleanup risks or ways the company might have to change business. I think today the way ESG is generally looked at, it's like if a company in any way pollutes, we don't want to own it. If the board isn't properly diversified across race and sex, we don't want to own it. And I mean, that's just not the way we look at things. We look at the economic impact. And I think one of the reasons this even happened is investors' time frames shrunk so much. And you got a typical investor who's owning a company now for 1 or 2 quarters, and they don't really care if the company's screwing the customers or the employees or whatever. The focus is just, can it earn as much in the next 6 months as I thought it would? It's very different than if you were the sole proprietor of that business thinking about trying to transfer it to your children at the highest maximum value. That person is naturally concerned about and aware of ESG type issues because they have very long-term impact. So we still look at them. I think the way some investors treat ESG gives us an opportunity. A lot of ESG investors simply won't own anything oil and gas. It's created a situation where most oil and gas companies sell at single-digit PEs, very high free cash flow yields, and we're happy to own them. If they don't want to continue investing, decapitalizing is a great way to make the value per share go up. And I mean, it's not like we feel like we're selling our souls to own an oil and gas company. The U.S. producers of oil are something like 30% more carbon efficient per barrel than non-U.S. producers. So encouraging the U.S. companies to stop producing and then have us increase our purchases from Venezuela, I mean, it might make the U.S. statistics look good, but it's a bad outcome for the world, for the environment. So I think, like value investors do with everything else we do, we try to take advantage of ESG investors that maybe don't have as long-term a time horizon as we do.
Yes, certainly. Over the years, we definitely see investors like holding period has shortened like very much. So I'm curious, like from your perspective, is there anything you would do differently if you were, let's say, managing like permanent capital?
It would be pretty minor. When we model companies, we're modeling out 5 to 7 years. We expect our typical holding will be in our portfolio for that long. If you're buying at 60, selling at 90, it would be great if our holding period was a day. We buy at 60 today, the market recognizes the value tomorrow, we sell at 90, and we just keep doing that constantly. Unfortunately, it doesn't work that way. Our typical holding, it's about 5 years before the market and our view of business value tend to collapse. So effectively, we kind of treat our capital like it's permanent, with the exception of we run an open-end mutual fund, so any day I come into the office, there could be a very large redemption. Doesn't happen often, but because of that, we have to hold a little bit more cash than I would hold if it was permanent capital, and I have to be a little more sensitive to liquidity of stock positions. So if it was permanent capital, I wouldn't care if I owned 20% of a smaller business. Mm-hmm. But when I have to worry that, if we have a really bad year, we could lose a third of our capital, I don't want to be a forced seller of something that has so much less liquidity.
Got it. At CBS, competitive advantage is something that we almost address in every single class. So just in terms of like, right now we see a lot of like technology and media disruptions. And for like many of your holdings, you mentioned it's gotta be like 3 to 5 years or even longer. So how do you assess, the company's modes, or what are some like specific, let's say, measurements you do to like measure like whether the company's moat is shrinking or widening? Could you give us an example of it?
So I think a few of the moats that we would consider really important would be brand value, and there are lots of publicly available measures of how strong a brand is. Cost advantage, lots of investments we're in, like Celanese, the chemical company. Their cost is significantly cheaper than peers. Again, that's something an analyst can monitor and actually quantify and measure. But some of the competitive advantages come down to corporate culture or something like that. That's a very difficult thing to measure. And I think that's one of the things we try to learn when we do management interviews, understanding what's important to them. Like how desirable a place is to work or not. Those things are all important to us as well. When you think out, like you said, we own a bunch of media names, and you're trying to look out 3 to 5 years and anticipate how the world might change. We like to anchor on things that we don't think will be that exposed. So, a good example of that would be Warner Brothers Discovery that we own. They own the Max, it used to be HBO, streaming service. And if our bet was just, is that going to be a success or not? I think you'd have to look at that as a huge array of outcome possibilities. But behind it, the real value is the movie library they have and television show library. So the way we look at something like that is there's one path where they're successful in direct-to-consumer, and that adds a significant piece of value on top of the value of the library. That's our home run outcome for this stock. But the downside outcome is 3 years from now, they decide they aren't going to be successful direct-to-consumer. And then they've got this great library that currently isn't earning them money inside of Max that they can now license to Netflix, Apple, Amazon. And we think that protects our base case. And so if they fail at direct-to-consumer, we don't think we'll lose money. And if they succeed, it's a large profit. So that's right now one of the most disrupted industries we're invested in. But kind of try to bifurcate between, despite the disruption, what are the values you're really sure of? And then make sure you're not paying too much for the possibility of success in the other area.
Such a great example. Thank you. Bill, you're such a master investor for more than 40 years. So there are a lot of things we should learn from you, in terms of your career lessons. So throughout your career, what are some key lessons that shaped your investment philosophy? How did you initially find out, oh, you're a value investor versus growth? We would appreciate some thoughts on that.
So I think there are lots of different ways you can succeed in investing, and it's important that you develop an approach that fits your own personality, because one of the difficulties in being successful in this business long term is the market makes you want to give up on your core beliefs at just the time it's most important that you maintain those beliefs. So I grew up in a middle-class household where always trying to stretch dollars as far as we could. I'd get dragged along on grocery shopping trips with my mom, and if grapes were on sale this week and cherries weren't, we had a lot of grapes in our house for a week, and then it could be the opposite the following week. So the idea that a price-sensitive consumer could extract value from the marketplace was something that was embedded in me from the time I was a little kid. So when I started getting interested in stock investing, and reading about the full array from hedge fund managers and commodity pool managers that might only own things for a day or two, to investors like Buffett and Graham, that was the end of the spectrum that was kind of consistent with how I'd learned to behave as a consumer. So I feel for me, being a value investor, I don't have this internal fight going on of, I'm one person when I'm an investor and I'm another person on my own time. It's the same person. And I think that lessens the chance that kind of give up when it's most important, that you stick with your convictions. In terms of lessons learned, I think the biggest evolution from the time you're a student to throughout your career, you come into the business, and I'm sure every one of you has quantitative skills that would run circles around what I can do. You can get stuff done on your computers much faster than I can. You know tricks that I don't know. And because that's your skill set, that's what you bring into the job on day one. And it's like they say, if you're holding a hammer, everything looks like a nail. I think as you evolve over your career, there's definitely value to the quantitative side, but you learn how important the qualitative is, and the importance of management and aligning with people that are smart, that are focused on the same long-term goals that you are. I look at some of our long-term holdings. Anything that we buy, we're setting a buy and sell target day one, and we're thinking the stocks maybe should be priced 50% higher than it should be. But we owned Alphabet. We still own it. Owned it for more than a decade. We owned Apple for more than a decade. And the value that gets added over time from decisions that you couldn't even have imagined the day you purchased the stock, allowed us to own Apple. I think we made like 12-fold our money on that over a decade. But when we first bought the stock, we thought we were going to make 50% on it. And just the importance of staying open-minded, adjusting your targets to the current business, not being anxious to take a win when a stock goes from 60 to 90, and investing with management teams that are creative and find ways to add business value. That a lot of times is way more important than the spreadsheet day one that showed whether it was a 40 or a 60% discount. I've often said that I think it's very, very difficult to model your way to a great investment idea.
We learned from some of your podcasts that you thrive on talking to smart people. So are there any people, let's say, do you have a buddy that in or outside your firm, whenever something came up to your mind, you present the idea, get feedback, and and if so, how did you find that person?
I think when you're successful in a business like this, it comes from, it becomes you. I tell people who say I'm considering going into an investing career that if you don't feel compelled to do that because investing is your life, you shouldn't do it. And because of that, I spend most of my time with other investors. Might be watching NCAA games tonight at a sports bar, but there are going to be 3 other guys in the investment industry that I'm sitting with. Close friends from business school, from the Applied Securities program, out to dinner with friends on Monday night. But it's all these people. So half of what we're discussing is friends and family and current events, but half of it is like, hey, did you see where this is selling? And when you love the business, that doesn't feel like work. That's just the way you want to spend your time. And if you don't have that kind of love of this business, I think it becomes a very hard business to succeed in.
Absolutely agreed. Yeah. We also learned from some of your other podcasts that you read value lines and use that as a good resource to source for divergence. So what are some other books or channels you would recommend us to read, to hope for one day that we can become a master investor like you.
Yes, I do read Value Line. What I find helpful about Value Line is it's a format that's easy to have with you. Over the weekend, I will be paging through this week's Value Line while I'm watching NCAA basketball games. Of 1,000 or so large companies, each one is going to get reviewed once a quarter in Value Line. And for me, that's a pretty good cadence for like staying on top of what's going on at that company. And after years of just kind of paging through Value Line, looking at each company, outliers start to jump out, where you say, hey, that's weird. This stock normally is at a much higher multiple, or this used to be at the top of its peer group, and now it seems like it's cheaper than everything else, and it drives you to start asking why. That is never an answer. It's a start that helps you develop questions. As a value investor, I have to say that I think the first book or two you read should be Warren Buffett, obviously the most successful long-term value investor. But something I don't like about most of the peers in value investing, it's like home cooking. You read the fourth book or the eighth book on Warren Buffett, and it makes you feel good and warm inside, but you aren't really learning anything other than maybe his dietary habits or something. And I like to read about Paul Tudor Jones, a commodity investor, or George Soros, or Michael Steinhardt, people that did things very, very differently from the way we did, to see if there's, are there one or two nuggets I can pick up, or something they do that would be useful for us, even though we do things completely differently. Like Michael Steinhardt, one of the first hedge fund managers and one of the longest tenured, most successful. He did something where over lunch, he would bring in the most bullish and the most bearish analyst on the same stock and basically sit there and watch them argue over lunch. And at the end of it, he'd decide which direction he believed. And like that created the idea for us to have a devil's advocate approach when we present new ideas. Somebody who's actually charged with the idea of saying, okay, you're presenting a new stock idea tomorrow. Your job for the next week is to study this as much as you can and tell us why she's wrong. And we watch that argument, and it really helps focus on what the differences are between the bear and bull cases, and helps us decide. Podcasts are obviously, that was something that wasn't around early in my career. I think there are a lot of really good ones. And one of the things I like about it is, unlike reading, it's something I can listen to while I'm driving or doing something else, so it's not using up such valuable time. I think there are a lot of good curators of investment stuff. I do like Real Clear Markets is something I look at on a daily basis. There's some that are more oriented toward value investing. Because if somebody else is going to put all the time into saying these were the 6 articles I read that I thought were the most interesting, I'd like to benefit from what they did rather than having to do that myself.
Thank you. And just to follow up on that, in the room we have a lot of career switchers. We have like lawyers, we have engineers, even doctors. So I think many investors have addressed the importance of accounting when you are doing investing. So what are some like advice you would give career switchers in the room? Like how can they improve their understanding of investing through a better understanding in accounting?
Take accounting classes. If you can't do that, get an accounting textbook. I haven't looked on YouTube. There are probably good accounting class lessons that you can take advantage of. I think it's so important because the way a company chooses to do its accounting can radically change the reported earnings numbers that we spend so much time analyzing. You saw the difference between LIFO and FIFO accounting. Early in my career, when we had double-digit inflation, massive difference. The same company might be reporting 20% different earnings based on whether they used LIFO or FIFO. And we started to see that a little bit last year when inflation ticked up to where LIFO or FIFO was starting to make a meaningful difference in reported earnings. You see it in the depreciation policies that companies choose to use. And I also worked very briefly in auditing, just an internship, but I think that also gave me an appreciation like how wide the band is of what is an acceptable number for a company to report. And you see how much of a reaction there is when a company beats a number by a penny or misses by a penny. And lots of times, maybe a range that the accountants would have allowed them to report might have been 3-4 times that wide. That you actually earn somewhere between 27 and 31 cents, and whichever number of those numbers you choose to pick, they'll sign off on. And the market will react very, very differently sometimes to the ends of those ranges when either would have been, they're both really reporting the same events. So yeah, I think accounting is definitely worth understanding.
Thank you. That's a great example you shared. So my last question before I open up to the class is, who are like the equity investors you admire?
I think today you have to admire Dodge and Cox. They do the same thing we do, long-term value investing, but they've succeeded in gathering a lot more assets than we have, which makes them a much more profitable business. So at scale, to be able to invest as well as they are doing, I think is extremely admirable. Have to follow like what Warren Buffett does. I'm friends with Ted Weschler, who works with Warren. He's somebody I always like watching what he does, learning why they did certain things. I think a lot of the private equity firms are worth watching. And for the specific companies that are their targets, by the time it becomes public, it might be too late. But a lot of times you can say these other public companies aren't that different from this target, and you can learn something about valuation from watching them. I mean, what we do at Oakmark, I like to say, we take a private equity approach to public investing. And when you think about what we do, we're buying something that we think the market will look at very differently 5 to 7 years down the road. That time frame allows us to look at things like what's competitive advantage, what are market share trends, how are the different business segments performing, what might they be worth if they were on their own. It's a lot of the same things that PE investors are looking at. Where is book value or PE ratio leading you to a number that's very different from underlying business value? Our fees aren't anything like private equity, 60 basis points and no carry instead of 2 + 20. But I think we can learn from the areas that they find attractive.
Hybrid fund investing is actually has been like a very popular topic. Has Oakmark ever thought about maybe one day investing in private market as well?
I don't think so. I don't think there's any reason to think we would have an edge in doing that. And I think it creates a big conflict then internally.
Absolutely. Yeah.
It's like the firms that used to run like standard mutual funds and hedge funds inside the same operation. Mm-hmm. and there's always that temptation to put the better ideas to where you get the higher fees. So I don't think PE makes sense inside of Harris.
Understood.
We're just good old-fashioned long-term value investing, and it's created good outcomes for us personally, and more importantly for our clients who've done a lot better than the market by investing with us.
Makes sense. Before I open to the public, are there anything that we didn't ask, but Bill, you wanted to share with us, or anything
I don't
you would like to touch on? Okay, cool. Now we're taking questions. Tom.
Hi, thank you so much for coming in and sharing your time. So my question's about one of your holdings, Lithium Motors.
Yep.
So they just kind of like went overseas and made a big acquisition. The inventory levels for dealerships are going up. Rising interest rates, there's just kind of a lot going on in that space. I'm curious to get your thoughts behind that investment thesis and kind of what your thoughts are on the future of that industry.
So the stock sells around $300 a share. They're supposed to make something like $50 a share, so it trades around a 6 times multiple. I don't think interest rates are going to be the determinant of whether or not we're successful on this, just given how large a discount PE is. One of the things we like about the company is the way they allocate capital. They're both willing to grow by shrinking, share repurchase, and also they can be a competitively advantaged acquirer where their stock's at 6 times earnings. They can maybe pay 10 times earnings for an acquisition, but then cut costs enough so inside of Lithia, what they purchased, they only paid 5 times for, so it becomes accretive. I think investors fear a couple things, the biggest of which is probably that the Tesla model doesn't use dealerships. And there's the concern that if we're all electric 10 years from now, it leaves the domestic industry completely behind, and the dealerships might sell at 6 times earnings because there might not be a future more than 10 years out. We've spent a lot of time on the legal contracts in the industry, and we think it's impossible is too strong a word, but it's very unlikely that the domestic dealers will be able to cut the domestic producers will be able to cut the dealers or bypass the dealers. The opportunity to expand outside the U.S. Sometimes that's been an issue for other retailers, but what they're acquiring is already a very successful chain of dealerships. So it's not like they're trying to take a dealership concept overseas and then see if what works in the U.S. also works over there. So we don't view that acquisition much differently than we would view continued expansion inside the U.S. I mean, it's a dull, no-growth industry, but at 6 times earnings, we think they should be able to grow 15 to 20% a year, largely because of reinvestment of free cash flow. Management owns a lot of stock, so there isn't any question of if their incentives are aligned with us or not. And frankly, we like how much skepticism there is about the industry.
Thank you.
Could you use the mic, please?
Okay, I think it's on. You had mentioned you guys interview management. You have these interview meetings. Can you share a little bit about your objective, how often you meet with them, maybe some of the things you're trying to look for to either choose management or to realize this is not what we want?
Yeah, so it's a big part of our process. It's the main reason why I'm in New York for a couple days this week. We've met with Omnicom, Etsy, Bank of New York, got Citigroup later this afternoon. We want to sit down with CFOs and CEOs and really get an understanding of kind of what's most important to them and how they are going to measure their success or failure. So like, for example, at Citi this afternoon, they have put out a forecast of an intermediate term, which I think they define as 2026, of reaching an 11 to 12% return on equity. Different managements use goals that they put out to the street differently. Some will put out a stretch goal and then go to their employees and say, I've committed to this, you need to help us deliver it. So they use it kind of aspirationally and motivationally. And that type of management team would be perfectly happy if in 2026 they achieved 10.5%. Because they're at 6 now, they thought they gave a stretch goal of 11, and they almost made it. And then there are others that if they think the real number is 12 to 13, they'll tell us 11 to 12, just to give themselves a little cushion so that it's like 80% probable they hit their goals rather than 50-50. So part of what we're interested in is trying to understand what mentality they have. And when Jane Fraser says we're committed to this goal, if they actually get to 10.8, is she popping the champagne cork, or is she going to be pissed off that they were short? And those are the kinds of things you don't get on a conference call, that kind of you have to sit across the table from somebody and see how they react to questions. Yeah. That kind of thing is, I think, one of the biggest things we can take away. We're really trying to understand how excited are we to invest with these people. Yeah. And there's some meetings you walk out of and you're like, these people aren't awful, they're not uninvestable. And if the stock's really, really cheap, I could get dragged into it despite the management. And then there are others that you're like, these people I'm so excited to have a chance to invest with. If the stock gets even close to typical valuation numbers, yeah, I want to make sure I'm looking at it and ready.
So you qualified potentially a management team that you get really excited about. What was it you noticed, or anything specific that got you like, I want these people?
It's passion.
Passion, okay.
It's the way they define their goals.
Realistic, or like?
There's a company we invested in, a healthcare products company many years ago. And the name of it was Kendall, sitting across the table from the CEO, Dick Gilliland. And a big part of the thesis that we were trying to confirm was the potential cost-saving opportunity. And they brought costs down, and there was a question of, is this going to be sustainable or not? And we were asking about that, and Dick says, my daughter and I own 6% of this company. It sells at 15 times earnings. Every dollar that's wasted is a dollar out of my pocket. And it's like, okay, I get the feel for how focused he is on
so high ownership
cost. And yeah, and I mean, alignment of goals. Like, is a management going to be happy if 5 years from now they tripled the share base and doubled the size of the business? As a shareholder, I'm not happy about that at all. But if they're measuring where they are, if they're measuring their success by where they are in the Fortune 400, it was a successful time period for them. So we ask lots of questions like, say to somebody who's relatively new in a CEO role, if you're in this seat as long as an average CEO, you're probably here 5 to 7 years. Pretend you're looking back on your time period. What are the things you hope to be most proud of? And it's amazing sometimes how those answers completely disconnect from anything that would be important to you as a shareholder of that business.
Cool. Thank you.
Yeah, please pass mic to Bill. Why don't you pick?
Thank you.
I'm not going to pick. You can do that.
Okay,
Location's
cool.
everything. But so you mentioned that you admire Warren Buffett, and who doesn't? But I find it interesting that he hasn't taken advantage of numerous opportunities, like on the dip or for the 2022 year, to buy a name like a Google or an Amazon. Apple wasn't his position to initiate; he inflated it. Any thoughts on why is that? Because when you talk about adjusting the income statement and the balance sheet and intangibles, that all makes sense, that it's not too complicated. So maybe just your high-level thoughts on why that's not more widespread throughout the value investing community.
I don't have a great answer for that. I know I spend a lot of time, one of the other things I'm doing in New York is meeting with clients and consultants. And I spend a lot of time having to explain, why does a firm that calls itself a value firm own Alphabet? I happen to think that question is like right into our wheelhouse because the answer to that is pretty good. But there are a lot of value investors that don't want to deal with that. There are, unfortunately, some asset allocators that also don't like dealing with it, and they'll just rule us out as a possible candidate for investment because we own too many of the names that they would call growth names. I think for people that don't have much accounting background, there's maybe not even an appreciation of how much of growth capital expenditures are getting expensed today. And I mean, face it, it's a pain to redo somebody's financial statements, but we do it all the time. And I think one of the other lessons you learn in 40 years in this business is that generally when something's really hard to do, the payoff can be pretty high, and when things are easy to do, not so much. This is a bit of a digression, but when I started in the business, coming from an accounting background, and I covered retail stocks when I was at Northwestern Mutual, I was really frustrated by some of them had credit card subsidiaries, some didn't, some owned all their stores, some didn't, some were on FIFO, some were on LIFO. So I put together this massive spreadsheet to try and make the accounting common across all the large retailers. And it took forever, royal pain to do. But the output, because it was something not many other people were willing to do, gave me effectively proprietary information. My assistant at work today, if I called her right now and asked her to run the same kind of screen that I did back then, she'd have it before this class is over. And because it's become so easy, the output is no longer of much use. What we are doing with recasting financial statements, it's a lot of work.
Thank you.
Hi, thank you for being here. You mentioned you hold Alphabet and Apple.
Alphabet.
Sorry, Alphabet. And you mentioned that you had a target price to sell when you initially bought, but because of some management decisions, you saw the value of the company just growing more and more in the future. Could you share what type of management decisions these are and how do you value them to understand what the potential is in the future?
Sure. So you were right, we did own Apple, we don't anymore. We bought that right around the time of the great financial crisis, so maybe 15 years ago, and we've sold it, maybe it was during COVID, like three-ish years ago. At the time we bought the stock, the prevailing view was that anything in consumer electronics, innovators get crucified and imitators end up destroying the market. So there were lots of digital music players that came onto the market at the same time that, what were they called? iPods, when they came out. And the expectation was that eventually, the large profit margins Apple was able to earn on that would get competed away, and that the same thing would happen to phones, et cetera. And you were able to buy Apple, which was growing at maybe 30% a year, at about 60% of the market multiple, because the expectation was there'd be a life cycle to this, and then the valuation, the growth opportunity would be gone. I think what the company did that most changed the trajectory was, like, through the App Store and some of the other things they did, iOS, they created an ecosystem kind of trapped customers, so that when you need a new iPhone, it's not really as somebody else's phone $200 cheaper, which easily you could do today. It would be a royal hassle for you to switch over from your iPhone to something else because so much has gotten tied into it. That was intentional on their part, and it was a massive change to both its growth trajectory and the multiple that you'd be willing to pay for the company because of its sustainability. In the case of Alphabet, YouTube would be one of the examples of things. When they bought it, and I don't remember what they paid, $1 billion or something, we thought they'd overpaid. I thought we were giving them the benefit of the doubt to say it might even be worth what they paid for it. And over a decade, they turned it into the largest number of viewing hours, the network, if you will, that has the largest number of global viewing hours, and have figured out how to monetize it through advertising. So, when we bought our stock, there was nothing in it for being able to create that kind of value. There wasn't a lot of in our initial numbers for what they would get for effectively advertising, for paying for the promoted results on search. And I think in the newer businesses, I think the uncertainty over how far you can go before it's fully monetized is probably one of the biggest opportunities. If I look at something like a Telecommunications Inc., we were big fans of John Malone, owned telecommunications stock, owned Liberty stock. It was value that was added through opportunistic acquisitions, which you value the assets on the balance sheet today. You rarely say, and I'll pay a 50% premium to that because there's a smart guy who runs this who I'm going to bet is going to add a lot of value through acquisitions. So things that were in our models at zero ended up being really important value drivers.
So you talked a bit about PE at the end, and I think one thing you said earlier on that stood out to me was that your estimate for the value of a business is the price that an all-cash buyer would pay to control and still earn an adequate return. PE's grown a lot in importance over the last couple of decades, and they obviously use a lot of leverage and financial engineering that enables them to pay prices above what an all-cash buyer would pay. I guess when you look at public companies...
Not sure I agree with that, but you can go on.
Okay. Like when you look at public companies in PE-heavy industries, are you willing to anchor into sort of the alternative metrics that PE uses, such as kind of like EBITDA? Or do you find that your process sort of keeps you away from those companies and industries?
Definitely the process doesn't keep us away from that. And we're more than happy to use EBITDA, as an important metric, although I think you have to be really careful when you're using EBITDA, how you comp it. Some companies' depreciation is a very big part of EBITDA, and other companies it's tiny. So you want to make sure if you're using EBITDA as a metric, you're only comparing to similar businesses. I think PE definitely juices returns by using leverage, but on an unlevered basis, the required return would also be significantly lower. And maybe there's not as much capital that would be anxious to earn a low-risk 12% as there is a levered 20. But I think to say that there's that degree of magic where you take a return that's inadequate and then you lever it up really big and suddenly you make it seem attractive, I don't think there's much evidence of that at all in PE.
Sorry. So it seems like your thinking is constantly evolving, right? And also you're very good at at identifying changes? For example, you mentioned Apple's ecosystem, and also, I guess, more broadly speaking, you correctly identify the kind of emergence of growth company or the importance of intangibles and then incorporated that into your assessment of value. So I was wondering, when you are looking forward, or even more broadly speaking, how do you strike a balance between being flexible versus being, sticking to the traditional value, which is something I guess some of your peers would criticize you are too growth-oriented, but in my opinion, it's just a reflection of your constantly evolving thinking, which is great. So, but then I guess my question is, how do you correctly identify those changing points and then be right about it?
Yeah, I mean, you're definitely right on value investing. Like there's a really fine line between being proud of being so patient and being stubborn. And I think, to me, the difference comes about with how the facts are changing and how the current environment differs from your original thesis. I think a lot of times value investors especially are guilty of not allowing their thesis to evolve to changes that are occurring. A lot of value investors, if they'd bought Apple when we did, would have been really happy with their 50% gain, not having adjusted their estimate of business value for all the new information that we did. I think when you look at change that's gone on in this industry, what we did 50 years ago doesn't produce value today. And I think it's really important that you think in terms of what fee am I charging my clients and what am I providing for that service that they can't get elsewhere. So before my career started, the average person's route to owning equities was through their neighborhood stockbroker. And that was a super expensive way of doing it, but it was their only way to really access this wonderful asset class we call equities. So when the first mutual funds came out, it's like, we're going to charge you 1% for something that largely tracks an index. That was hugely more attractive than the neighborhood stockbroker. And that stockbroker never really evolved and kind of got put out of business. The 1% closet indexer got put out of business by the index fund. From index funds, then we went to kind of factor funds or something where you'd have a value fund that does all the low PE, low price to book companies. And that you can get that for almost free today. So the idea that you can charge 50 basis points for a portfolio that's just a bunch of low PE and low price to book stocks, unlikely that's going to work because that product's being offered for free. So my whole career, we have had to evolve from what worked well looking backwards to understanding why it doesn't work anymore and what we have to do differently to continue providing value. I don't know how that's going to change during your career, but I do know it will change. And if you say, wow, I really